Hey everyone! Today I'm going to dive into how central bank policies influence market trends. To make it exciting and easy to understand, let's go on a journey with two fictional characters, Alex and Priya, who run their own businesses. Alex runs a trendy cafe called Bean Bliss in the heart of the city, and Priya owns a boutique clothing store called Chic Threads. Both of them are feeling the effects of changes in the economy, but they don't quite understand why. That's where central bank policies come into play. Imagine the central bank as the coach of a huge sports team. They have two main tools to influence the game: interest rates and quantitative easing. Interest rates. This is like the central bank's way of deciding how expensive or cheap it is to borrow money. When they cut interest rates, it's like giving out discounts on loans. When they raise rates, it's like increasing the cost of borrowing. Quantitative easing, or QE. Think of it as the central bank buying a bunch of assets, like government bonds, to pump money into the economy. It's like adding more fuel to the economic engine, making it easier for businesses to get loans and for people to spend money. One day, the central bank decides to cut interest rates. Since borrowing money is now cheaper, Alex decides to take out a loan to expand Bean Bliss and add new locations. This expansion leads to hiring more staff and buying new equipment. With more people having jobs and spending money, Alex's business benefits from increased customer traffic. Takeaway: when the central bank cuts interest rates, it encourages businesses like Alex's to borrow and invest, which can lead to growth and more jobs. Now, let's see what happens when the central bank implements quantitative easing. They start buying government bonds, which floods the financial system with cash. Priya notices that banks are now offering better loan terms and have more money to lend out. She decides to use this opportunity to get a low-interest loan to revamp Chic Threads and stock up on trendy new clothes. With more money available in the economy and lower interest rates, Priya's customers feel more confident and spend more on fashion. During the 2008 financial crisis, central banks around the world, including the Reserve Bank of India, (RBI), slashed interest rates and implemented quantitative easing to stimulate the economy. This helped businesses recover and encouraged consumer spending, even though it took some time for the effects to be fully felt. In more recent times, during the COVID-19 pandemic, central banks again used these tools to support the economy. Key insights. Lowering interest rates makes borrowing cheaper, which encourages businesses to invest and expand. Quantitative easing. By buying assets and increasing the money supply, the central bank makes more money available in the economy, encouraging spending and investment. Economic ripple effect. Both tools can lead to increased business activity and consumer spending, but they also have long-term effects on inflation and economic stability. So the next time you hear about the central bank making policy changes, think of Alex and Priya and how these decisions impact their businesses and the broader economy. Thanks for tuning in, and don't forget to like, share, and subscribe for more financial insights. Catch you next time.